Now it's time to gather the data that we're going to need for predicting our pre and post retirement returns for the second run. Now I've opened the instruction sheet and I've scrolled down to table 3A, which is my pre-retirement asset allocation analysis. And I've made some minor changes, but I think they'll help you. I will post the updates to the website in a little bit. But I'm just going to click anywhere in this table, and that activates this little icon up here, this little plus sign. If I put my cursor over it, it highlights the whole thing, and I'm just going to copy it into Excel because I want Excel to do my math. I don't want to have to tediously crunch through all these myself. I'd suggest that you use Excel too, but you don't have to. And then I just want things to look good, so I'm going to widen that first column and make all my rows narrower, so hopefully it'll all fit on the screen at once. Now I need to input the expected return for each asset class. Now not every fund that my demo people invest in contains bonds, and not every fund has real estate investment trust, for instance. I simply put all the asset classes that were listed on a particular website on this table so that you could fill them in if your funds had them, but you can leave them blank if your funds don't have these asset classes. So where can I come up with the expected returns, the future long-run expected annual return for a particular asset class? Well, you could do what Paul Merriman did in his book Financial Fitness for Life, and he just assumes that the long-run history will repeat itself. So asset classes have generated X percent of historical long-run return and have had X percent risk. He's assuming those patterns will hold true in the future. You can do that, but you'll have to go and calculate the historical returns for each of these asset classes, and it's just going to be time consuming. I don't expect you to do that, though. I'm willing to let you use this website called Portfolio Solutions. The link to that is on the Canvas website, and once you click through that link and you scroll to the bottom of the page, you'll see 30-year annual or estimated annual returns for these different asset classes. Now, they assume a 2% inflation rate, and that may not be a valid inflation rate for you to use in your scenario. So what you need to do is work with this first column of expected returns. These are the real returns, and then you need to add your inflation percentage to those. So I am just going to take a moment to copy the numbers from this first column into my tab, and I'm not going to record that, so when I come back they'll be inputted. So I have the expected real returns inputted from the Portfolio Solutions website, and now I'm going to add an extra column, and this will be my expected nominal returns. And I can't help myself, I have to make that the same font. All I'm going to do in column C is add my inflation rate that I'm using during the second run, and I believe that was 3%, so I'm just going to take 3% plus the, I'll get back to this one. I'm going to take 3% and add it to the number in column B. Except for this one, I don't know what the actual return for cash will be in the future. Cash includes things like your checking account, certificates of deposit, things of that nature. I just simply estimated a nominal return for cash of 1.25%. So just pop that over to your nominal column. But then, so I've added my 3% to the value in the previous column, and I can just drag this down and it should work fine. Oops, it didn't like that. I'm just going to copy it and paste it. I don't know why that paste isn't working. I'll just type in 3% again. Oh, what the heck is going on? I don't know why it didn't like that. So column C contains my nominal expected returns for all the different asset classes from the Portfolio Solutions website. Now it's time for me to look at my Sims fund choices for the second run and estimate an expected return for them. And I need to do this on a pre-retirement basis and a post-retirement basis. Right now I'm just doing my pre-retirement one, and I'll just label that pre-retirement run number 2. So the first fund that they have their money in is VASGX. And I need to figure out how that fund has all of its assets allocated across these different classes in column A. So this is going to be some guesswork on my part. I can go through, it is actually possible to get this fund's prospectus and look at every single asset that it owns and categorize it myself. But they, some funds own 2,000 assets. I don't want to go through all of those and classify them myself. So what I'm going to do is use Morningstar's classification scheme, and I know it's not perfect, and it's not going to give me perfect numbers. I'm going to lump some assets into classes using pretty broad definitions, but it's better than my having to go through and classify each asset myself. I don't want y'all to have to do that. I don't do that in real life. So I'm going to pop over to Morningstar. Here is the first fund. It's the Vanguard Life Strategy Growth Investors Fund. And under the Portfolio tab for the fund, I can see the broad asset allocation. So they've got 1.36% of their money in cash, 55% in U.S. stocks, 24% in non-U.S. stocks, about 15% in bonds, and 4% in other. You don't need to worry about the other classification. I am fairly certain I didn't choose funds that had high values of other. So I'm just going to ignore the other classification. So I'm just going to pop over to my spreadsheet and enter those percentages. So cash for the Life Strategy Fund was 1.36%. Fixed income, and here I need a new column, and I think I'm just going to type fixed income in here and get rid of that column. I also need it that way for domestic equities, because in a minute I'm going to put a percentage here. It'll make sense in a minute, I think. The rest of it looks good. Okay, so for fixed income, the Life Strategy Fund had 14.84% of fixed income. For domestic equities, it had 55.17%. For international, I do need a new row for that. All I'm doing, I merged this cell in my Word document, basically this particular row, and so I can't come here and type values in these specific cells. and I don't actually need to for equities, but for the column that's labeled domestic and the column that's labeled international, I do need to type specific numbers in these cells. So that's why I added a new row that wasn't merged. I'm sorry, I'm perhaps making this look more complicated than it actually is. So now, for international, the Life Strategy Fund had 24.22%. So this should add up to about 96% for for my particular fund. So if I sum these four numbers, that should be approximately 96%. The reason it's not 100% is because this particular fund had about 4 or 5% or so in other, and I'm ignoring the other. So I've got my broad allocations. Now I need to get to the nitty-gritty, and I see this fund has some fixed income, some debt. It also has some domestic equity and some foreign equity. So I need to get more specific with my weights, because you can see, like, across these different equity asset classes, there are different expected returns, and the same for the different fixed income asset classes. And here's where guesswork comes into play, because they don't specifically say we own this many short-term T-bills, we own this many intermediate term treasuries, we own this many securitized Ginnie Mae mortgages. So I have to just take the information that's available on Morningstar and try to classify the fund's asset classes. So with under the portfolio tab, if I look at this holding style, the 9-cell matrix that Morningstar reports, I can see that, and these are percentages, so this particular fund has 25% of its assets, of its equities, not all of its assets, just its equities. 25% of its equities are in large cap growth stocks, 6% are in mid cap growth stocks, and 2% in small cap growth stocks. In looking at my asset classes under the equities, I see that the Portfolio Solutions website only gave me 3 cap categories: small cap value, and large cap. If I pop over here, I see that there are actually 9 equity categories provided on Morningstar: large cap growth, large cap blend, large cap value, and then the associated mid and small cap growth, blend, and value categories. So I'm going to have to take these 9 categories and condense them to just 3. So I'm going to pop these 6 that I have highlighted, 6 categories, into the large cap category. So basically I'm saying, okay, 75% is the sum of this first row, 18% is the sum of the second row, so 75% plus 18% is what I would input into the large cap weight here. And I'm too lazy to do that math in my head. So 93% of the Life Strategy Fund, I'm saying, goes into the large cap value, or large cap cell. That tells me then that 7% has to go be allocated across small caps, but they've broken small caps into 2 special categories. They've got small cap value and just regular small cap. So I'm going to say the regular small cap represents small cap blend and small cap growth. So popping over here, small cap blend and growth. Oh, it's hard to highlight. I can't seem to highlight just those 2 cells. So small cap blend and growth, total 4%, and small cap value 3%. So 3% here and 4% here. So that sums to the 100%. Now, unfortunately, without digging into a whole lot of detail that I don't want y'all to do, I don't know exactly whether these are, maybe all their small caps are international stocks, and maybe all their large caps are domestic stocks. I don't know, and they don't tell you that on Morningstar. All they tell you is this broad breakdown, domestic versus international. So what I'm going to do is use these same exact percentages down here for small cap value, and then regular small cap and regular large cap, simply because it would be a whole lot of effort and an amazing amount of effort for you to find that information out specifically, and you'd have to go through each company stock that they hold and see what company it originates from and whether it's a small or large cap, simply because they don't report that on Morningstar. But one thing they do report is what percent is developed markets versus what percent is emerging markets. And that I can find under the portfolio tab. You scroll all the way to the bottom and it gives you this market classification. And I can see that 95.25% are developed and 4.75 are emerging. So I'm going to input that here. I had no real estate investment trust. It didn't note that in any of the information that I saw. So I'm just going to leave it blank. Now it's time to categorize my bonds, my fixed income securities. The first major classification I need to know is what percentage are government backed, what percentage are corporate issued. So under my portfolio tab, so again, my portfolio tab right here, I go to style details, and there's equity style, and then you can click on bond style. And there's also equity sector and bond sector. I want this time the bond sector. So I can see that first, I know that this fund doesn't have a huge percentage in bonds, a little less than 15%. Of that 15% invested in bonds, 47% is government issued bonds, 22% corporate, 23% securitized, a very minor amount is municipal bonds, and then about 8.35% falls under what they call cash and equivalents. That's a little bit different than this cash percentage. So this cash percentage is the one you should use for the cash asset class. This cash percentage is really just very low risk, probably U.S. Treasury securities, and they have their own separate line on the spreadsheet. So what I'm going to do now is just input these percentages, these bolded percentages from the website. So they had, first I'm going to do the corporate issued. They had 22.08% in the corporate issued. They had 8.35 in what they called cash and equivalents. I'm popping all that into U.S. Treasury bills, 1%, or less than 1 year. They didn't specifically tell me what that was, but it should earn approximately the same return as those. Now, I need my government-backed. So there's the 45.37. And then securitized, those are called the Ginnie Mae mortgages on the Portfolio Solutions website. So that's what I called them. So government backed 45.37%, and then under securitized it was 23.4%, and then municipals it was an incredibly low percentage, but I'll put it in there anyway. All right, these highlighted cells should sum to 100%, and they do. And I don't know if I can highlight them properly, but note that this cell is actually active. These three cells should sum to approximately 100% as well. Oops, plus cash. So these three grayish cells plus cash should sum to about 100% unless you had an other category. Now I need to evaluate the corporate issued. I've allocated my government-backed ones. I need to do my corporate issued now. Okay, so pop back over to the portfolio. And here I'm going to look at, I know they have a place that shows me the corporate issued. I have to find it. Oh, basically, if we go and look at corporate issued are broken into just a couple of categories. There's essentially investment grade or below investment grade. And investment grade is divided into short term, which they classify as 10 years or less, or long term, which is over 10 years. And then all the foreign bonds, they only came up with one expected return for foreign bonds, lumping high quality and low quality and long term and short term foreign bonds into one single estimate. So essentially I just need to figure out this information. So I need to know their grade and I need to know their maturity. Which I know is here somewhere. Here we go. Here's their maturity. Essentially, it's broken down by under 10 years or over 10 years. So I see that, I don't know if I can highlight that, these four rows are my 10 years or less ones. So I need to sum these four numbers to get my 10 years or less. And these would be my 10 years or higher. Okay, so to determine the total percentage that they have in domestic investment grade bonds that are shortish term, so less than 10 years, I'm going to use the sum of these first four columns, the percentage bond sum of these four columns. So the 24 plus the 16 plus the 10 plus the 10. And I'm just going to let Excel do that math for me. I can't forget to type in my percentage signs on all of them. So that's the total weight in domestic grade, investment grade domestic shorter term bonds, and then the longer term ones would be the sum of those remaining numbers, but I'll pop over there and highlight them. So the sum of these four numbers right here, the 3, 4, 25, and 4. Now I actually need to see whether these are below investment grade or above investment grade, and I know they tell me that information. I'm going to go on a quest to find it. Okay, it's under portfolios, style details. You have to click on bond style, and here's the credit quality. So anything triple B or above is considered investment grade, and anything below triple B is below investment grade. So they do not have any below investment grade. All of their bonds are investment grade. So I was correct to put um, all of them in just the investment grade because they don't have any below investment grade. And they really don't have any significant foreign bonds either, so I'm leaving these two blank. Okay, I'm sorry, I noticed that I did something incorrect. Um, Over here, I can see that they've got 45% of their bonds in the category that Morningstar calls government. But it doesn't break it down into treasury securities or short-term treasury securities versus long-term treasury securities. I just know that about 45% is in government bonds, and I need to break that down to some degree. I know the cash percentage because they told me that on Morningstar, but I need to break this 45% into some short-term government bonds and some longer-term government bonds. And I'm not so horribly concerned about whether they go into row number 9 or row number 10 because the difference in the actual expected returns is very minimal. So what I'm going to do is use the same breakdown between short-term and long-term that I used right here. So I'm going to say 61.41% of this 45 is short-term, and 38.59% of this 45% is long-term. And so I'm just going to take 0.6141 times 0.4537 to get a percentage for 1 to 10 year government bonds, and then I'm going to take the 0.3859 times the 0.4537 to get a number for the over 10-year U.S. Treasuries. And I'm going to actually delete this. Oops, no, I don't want to delete that. I'm not going to use this number in any calculations, the 45%, other than these two calculations that I just did. And I'm just going to shorten the number of decimal places so it looks a little better. Okay, now it is time to calculate an overall expected return for my fund. I'm trying to figure out this number. So I've got all the weights, all the expected returns, nominal returns in column C, and the weights in column D. This is going to get complicated. And I'm trying to figure out how best to do it. I'm just going to do it in Excel. But I think I'll do it in increments so I can show you how to do this if you're working it the long way. There's no need to do it in increments if you're doing it in Excel, but I will. So first, I know that basically I need to get an expected return for each major category. So I know that they have 1.36% invested in cash, and cash is expected to earn a return of 1.25%. So to calculate cash's contribution to the overall expected return, I take that 1.36 times the 1.25. So that's cash's overall contribution to the expected return. Now I need fixed income's overall contribution. Fixed income is only about 15%, but it is weighted all these different ways. So I'm going to do this in increments again. First, I'm going to figure out corporate bonds contribution to the overall expected return. So corporate bonds, about 61% of them are expected to generate a nominal return of 4.7%. So multiply those two together and then add to it the approximately 40% that's expected to generate a 5.5% return. So this is the overall expected return for corporate bonds, but they only make up 22% of my portfolio, so I need to multiply by that 22%. So I am, oh, I see I have a mistake in my formula. It should be C16 times, C15, sorry, times D15. That's a better looking percentage. And it should make sense since most of my corporate bonds are expected to generate less than 5%, and a little less than half are going to generate about 5.5%. The average is about 5%. But this only makes up 22.08% of my portfolio. So take that percentage, multiply by the 22.08%. So this is corporate issued bonds contribution to the return of the portfolio. And I don't know if y'all noticed what I just did right there, but it was in this cell and I wanted to pop it up to this cell because that's the one that's the corporate issued label. I'm just trying to keep things neat. Now I would like a value for my fixed income portion, which is comprised of some government-backed, well actually all government-backed. Oh, let me restate that. I want a number for the government-backed portion of my fixed income, which is broken down in these different allocations. I just want to point out that this 45.37% number is not one I want to use again. So I'm going to put make it orange just to bring it to my attention. Because remember, I use this 45% to determine these two percentages. These two percentages actually sum to that 45%. So I am done with this 45%. So there are a few ways I could do this. I think I'm going to do each one separately. So cash, or sorry, U.S. Treasury bills of less than 1 year are 8.35% times an expected return of 3.1%. I'm just going to copy this equation down through to municipals. And actually, I'm going to pop these over one column. And then what I would like to do is sum all of these and multiply by 14.14%. Now I need to do the same thing to these numbers that I did to this number. So let's talk about exactly what I did to get this 3.35. I weighted each of the domestic or corporate issued classifications by their weight and multiplied by the expected return, and I summed them. So this highlighted section is these two cells plus these two cells. Then I multiplied it by the 22.08% because domestic corporate issued bonds are only 22% of the fixed income portion of the portfolio. So I need to do the same thing for this section. Because of the way the portfolio solutions categories are designed, I don't actually have a number that represents the this entire section. So I really need to redo that. Basically, if corporate bonds, okay, I have two main categories for fixed income, government backed and corporate issued. If corporate issued is 22%, then government backed has to be the remaining percentage. I originally got this percentage from Morningstar because they called government backed, they had a section called government backed, but it didn't include securitized mortgages, nor did it include cash and equivalents. It just included these two. So technically my government backed should really be 100% minus 22%, although I don't want to change this number because it's included in these two calculations. So essentially what I'm going to do, I've already multiplied this column or this cell by this cell to get this number. I took this cell times this cell to get this number. Now I need to sum them all. So I'm going to sum them here. And then I need to weight them by multiplying by 1 minus the corporate issued to get the true government-backed percentage. So 1 minus this 22.08%. That puts this number in the same context as this number. These are all percentages, so I'm going to format them like that and just carry them out to a couple of decimals. That's all I really need. This is now the total actually, I'm going to pop this over one more time because I'm trying to keep them organized by what unit they're in. Basically, this 2.56% represents the fact that I've got different weighting schemes in all these highlighted classes, and they represent about 77% or 78% of the fixed income portion. So if I look at these rates and I look at this number should be less. It's equal to about 78% of this weighted value for the Life Strategy Fund. Looking at this number, it should be about 22% of the weighted average of these numbers. But now it's time to consider the fact that government-backed and corporate-issued bonds only make up 14.84% of my portfolio. So here I'm going to sum this number and this number, and then multiply it by the weight that fixed income is of the whole Life Strategy Fund. The equities will be easier, I hope. Okay, so for equities, 3% is in small cap, 3% of the domestic equities is in small cap, which is expected to generate a 9.4% return, plus 4% is in small cap value, which is expected to generate a 10.4% return, plus, well, actually, I'm sorry, I'm just going to do it the same way I did it before. So 3% times 9.4%, 4% times 10.4%, 93% times 8.4%. I now want to sum these three values, which I will do here, And this will actually go in column P because column P is where I'm doing my final weighting. These had some sub-weightings that needed to occur. These do too, but only one sub-weighting scheme needs to happen here. Essentially, the 55.17% is the proportion of the entire life strategy portfolio that's in domestic equities. So now if I take the sum of all three of these multiplied by 55.17, that will give me the domestic equity contribution to my whole portfolio. So I'm summing these three and multiplying by the proportion domestic equities are of my entire portfolio. Now I want to do the same thing for international equities and emerging markets. Well, for the developed and emerging markets. Now, developed and emerging markets have two categories. These two sum to 100%. Oops. So what I need to do is take the emerging markets weight times its expected return, take the developed market weights, we'll have to up here, I guess, the 3% in the small cap value times the 10.4% expected return. I'm going to drag those down because they copy nicely. And note that these three numbers sum to 100%, the 93 plus the 4 plus the 3, so 95% of the 24% is allocated across these three asset classes. So now I take the sum of these three numbers, multiply by the 95.25% weight to get this 8.9%. And now over here, to get the international contribution, I will sum these two values. I think I need to put a comma there. And then I'll multiply by the international equity weight. Finally, if I sum all the values in column P, that should give me my overall expected return for the Vanguard fund. So I am going to put that here. So 7.68%. Now I need to know the fund's annual expense ratio. That is easily available on Morningstar. It's just right under the quote section. Now their expense ratios can change every year. I'm not going to worry about that. Let's just use the expense ratio that's right here. So 0.17%. You'll need to deduct this expense ratio from your 7.68. So just right here, I'm going to plug in equal 7.68 minus this expense ratio. And actually what I'm going to do is do it the exact way I said I was going to. So there is my after expense expected return. Now my weight for my fund, my Sims had $32,000 saved up. At least Joe did. This is just for Joe. Joe had $32,000 saved up, and Jane had $12,000 saved. So And in this particular fund, the Life Strategy Fund, they have $16,000. So I need to do $16,000 divided by the total that they have, which is the $32,000 that Joe has, plus the $12,000 that Jane has. So about 36% is invested in the Life Strategy Fund across Joe and Jane. But you actually enter these two separately. I enter Joe separately and I enter Jane separately, so I really need to just do Joe's. Sorry. I should write a little script for these videos before I make them. So Joe has 50% of his money in the Life Strategy, and he has 15% of his money in the Small Cap Growth one. So what I would do is this whole process for his second fund, which is the VISGX, the Small Cap Growth and Index Investor Fund. I've actually already looked up those numbers. They have a very minimal amount in cash, 0.3%. They have no fixed income. Actually, 98.08% is in domestic equities. 1.62% is in international equities. 49% is in small cap, 3% in small cap value, and 48% in large cap. And so I'm just going to use the same percentages down here. I'm not copying them because I see I've got them in a different order down here than I do up there, so I'm just going to type them in. So my small cap value is 3%, small cap is 49%, and large cap is 48%. So even though it said it was a small cap growth, they do have what I called large cap. I actually think they had a moderate amount of mid cap companies, which I classified as large cap. And they didn't have any emerging markets, and their expense ratio was a little bit higher at 0.24%. So I would perform the same math over here that I did for the Life Strategy Fund. I do it for the Small Cap Growth Fund and come up with a number and a weight. I'm not going to go through that process right now. Well, actually, I will. I'll come back in a second with the numbers. Okay, I have crunched those numbers and I got 8.93% before deducting this annual expense ratio. I'll deduct the expense ratio in a moment, but I want to talk about something first. Look at these numbers and make sure they make sense. This fund in column E is a small cap fund, so it's got a much higher percentage of its money in small cap domestic equities in this particular case. And domestic equities, small cap, are expected to generate a higher return than large cap domestic equities. Plus, this fund has nothing in fixed income securities, which have smaller expected returns. So this number, the 8.93%, should be higher than the Life Strategies Fund because it's a more diversified funds, more bonds, which have lower expected returns. Here's so like if I'd gotten a number for E31 that was less than D31, that wouldn't make any sense based on the types of funds they are. So now I've got to deduct the 0.24% return. So there's my revised after expense expected pre-retirement number for the fund. And since this is just for Joe, because Jane's numbers get entered separately, Joe again has $16,000 of a total of $32,000 invested in this fund. So there's the weight in the small cap growth fund. So ultimately I need an overall number to input into the spreadsheet for Joe's pre-retirement expected income for run number 2. It needs to be a weighted average of all the numbers you've got down here. Most of you will have 2 or 3. This one will have a total of 3. For Joe, Actually, no, I'm sorry, let me restate that. For each person, each sim in your scenario, you need to have a weighted average of their numbers, which may be more than two. It could just be one. Joe has his funds in just two mutual funds, these two. So to come up with Joe's expected pre-retirement return, I need to take the expected return for his first fund times the weight of that fund plus the expected return for his second fund times the weight of that fund. So the overall expected return for Joe's pre-retirement run number 2 would be 8.1%. So that's what I'd enter into the second run spreadsheet for Joe's expected return. I'd do the same thing for Jane and enter her number. Jane's easy. She only has one fund, and it's the Janice 20 fund. So I'd follow this entire process for Janice 20, and I'd come up with this number for Janice 20, and except for Jane's weight, it'd be 100% and not 50%. And so then I'd have Jane's expected pre-retirement income, or return, not income. I would do this again for their post-retirement. Sometimes in some of the Sims scenarios, I made them change their funds from pre to post-retirement. In other scenarios, I said they were going to keep their money in the same fund. So for some of you, calculating post-retirement will be identical to pre-retirement for run number 2. For others, it won't be quite that easy. For everybody's run number 3, though, I wrote the scenarios in a way that it's not a good idea to keep your pre and post strategies identical. So for run number 3, everybody would have a separate pre-retirement and post-retirement expectation.